Trading Forex can be exciting. There's potential for big wins, but many traders, especially beginners, face a frustrating problem. They place a trade, set their stop loss, and watch in dismay as the price moves against them, triggering their stop loss. Just when they're about to give up, the market often reverses, moving in the direction they initially predicted. Why does this happen? And more importantly, how can you avoid it? This frustrating scenario is more common than you might think. It's the bane of many traders' existence, leading to unnecessary losses and shaking their confidence. But don't worry, there's hope. By understanding the reasons behind this phenomenon and adopting some practical strategies, you can significantly improve your trading and start seeing those winning trades you've been dreaming of. This isn't about luck. It's about understanding the market and making calculated decisions. In the following sections, we'll delve deeper into the reasons why your stop losses might be getting triggered prematurely, and more importantly, how to outsmart the market and improve your entry points for more profitable trades. Get ready to take your trading game to the next level. The Forex market is a dynamic beast influenced by a myriad of factors. Understanding these factors is key to avoiding those dreaded stop-loss triggers. One major culprit is market noise. Think of this as the random price fluctuations that occur throughout the day. These fluctuations can be triggered by news events, economic data releases, or even just large orders being placed. Another factor is volatility. Some currency pairs are inherently more volatile than others. They experience wider price swings, making them more susceptible to hitting stop losses, even if the overall trend is in your favor. This is where understanding market conditions becomes crucial. Finally, we can't forget about the spread. The spread is the difference between the bid and ask price of a currency pair. When you enter a trade, you're essentially starting off in a slight loss equal to the spread. This means that even a small move against your position can be enough to trigger your stop loss, especially if you're using tight stop losses. Now that we understand why stop losses get triggered prematurely, let's explore some strategies to improve your entry points. One effective approach is to wait for confirmation before entering a trade. Don't just jump in because you see a potential opportunity. Look for confirming signals such as candlestick patterns, technical indicators, or breakouts from key levels. Instead of using market orders, which fill at the next available price, consider using limit orders. Limit orders allow you to set a specific price at which you're willing to buy or sell. This gives you more control over your entry point and can help you avoid getting stopped out by sudden price spikes. Another strategy is to consider using wider stop losses. While it might seem counterintuitive to widen your stop loss, it can actually be beneficial, especially in volatile markets. A wider stop loss gives your trade more room to breathe and reduces the chances of it being stopped out by random market noise. Section 4, the power of patience, mastering timing in Forex trading. Patience is not just a virtue in life, it's a crucial skill for successful Forex trading. Many traders make the mistake of jumping into trades too quickly, eager to capitalize on every perceived opportunity. However, this often leads to impulsive decisions and poorly timed entries. Remember, the market is not going anywhere. There will always be new opportunities to trade. Instead of chasing every pip, focus on identifying high probability setups and waiting for the right moment to enter. This might mean waiting for a pullback to a key support level, or for a confirmation signal from your indicators. By exercising patience and discipline in your trading, you can avoid emotional decisions and significantly improve your chances of success. Remember, the goal is not to trade frequently, but to trade effectively. Section 5, Risk Management. Protecting your capital in the Forex arena. Risk management is paramount in Forex trading. It's not just about making profits, it's also about protecting your capital from unnecessary losses. One fundamental rule is to never risk more than you can afford to lose. Determine your risk tolerance and stick to it. Another important aspect is position sizing. Don't put all your eggs in one basket. Instead, diversify your risk by trading multiple currency pairs and using appropriate position sizes based on your account balance and risk tolerance. Remember, trading is a marathon, not a sprint. By managing your risk effectively, you can stay in the game longer and increase your chances of achieving consistent profitability. Section 6. Ready to trade smarter? Stop letting the market take your money. By understanding why your trades are hitting stop losses prematurely and implementing the strategies outlined in this essay, you can gain a significant edge in your Forex trading. Remember to wait for confirmation, use limit orders, consider wider stop losses, and most importantly, Be patient and disciplined. If you found these tips helpful, don't forget to like this video, share it with your fellow traders, and subscribe to our channel for more insightful Forex content. See you in the next video.